Global, global government debt levels have been growing rapidly over the last 25 years. We're now forecast to exceed $100 trillion by the end of this year. For developed countries, the average ratio of public debt to GDP is back to where it was in 1945. That was when public debt rose above 100% of GDP after 2 world wars and the Great Depression. The recent surge in borrowing was driven by a series of shocks. First came the global financial crisis. Then the pandemic hit. Finally, the Russian invasion of Ukraine created new pressures. For most of that period, interest rates were low and falling. But since the pandemic, we've seen a spike in inflation globally. This pushed interest rates up, meaning any new debt being issued is much more expensive. Yet this hasn't stopped governments from borrowing and spending. A quick glance at the news shows that even as rates rise, budget deficits around the world are projected to grow. Government spending in most countries has remained high since the pandemic for several reasons. Politicians tend to spend more in election years, and 2024 was the biggest election year in world history. 72 countries representing half the world's population held elections. Governments spent heavily to win re-election. Now, newly elected leaders are spending even more to fulfill their campaign promises. So where is all this money going? Globally, there's been massive climate change spending expected to continue or increase. In Europe, we saw high government spending to shield consumers from gas price spikes. Geopolitical tensions worldwide mean military spending is expected to grow in coming years too. Last year, global government spending hit its highest level ever outside of a crisis period. The biggest driver? Rising interest rates on government debts. This week, the U.S. Treasury Department saw soft demand at a $16 billion 20-year bond auction. This caused stocks in the dollar to sell off while Treasury yields rose. Reuters reports the weak auction shows intensified investor worries about ballooning U.S. debt. It could spur bond market vigilantes demanding more fiscal restraint from Washington. This came after Moody's downgraded the U.S. government's credit rating. They cited growing debt and little progress toward resolution. The move wasn't surprising. Moody's was the last of the big 3 rating agencies to act, having warned about this possibility 2 years ago. The 30-year U.S. Treasury yield rose above 5% earlier this week and has stayed there. In Japan, events were even more dramatic. The weakest demand seen at a government debt auction in over a decade drove 20-year government bond yields to 25-year highs. 30-year Japanese government bonds hit their highest yield since being first sold in 1999, an all-time record. 40-year bonds also rose to a record high of 3.7%, a full percentage point higher than early April. As the FT notes, such a sharp move from low starting points means investors in those bonds lost nearly 20% of their investment in weeks. The Japanese yield curve isn't just upward sloping, it's the steepest in the developed world. Normally, this means longer maturity bonds pay higher interest rates. But in the current chaos, the 35-year bond, issued 5 years ago as a 40-year bond, now yields over 100 basis points more than the 40-year bond. This makes no sense in a steep upward sloping yield curve. The reason? The 35-year bond is much less liquid than the newer 40-year bond, what's known as an off-the-run bond. It's trading at surprisingly higher yields because investors fear being stuck with hard-to-sell bonds if prices collapse further. The FT calls this stark evidence of evaporating demand for longer-term Japanese debt. This kind of drama in supposedly safe developed market government bonds shows what happens when investors retreat from lending to highly indebted nations. Japan now has the world's highest public debt to GDP ratio at over 240%. Back in 1990, this ratio was just 50% of GDP. Over the same period, U.S. debt to GDP grew from about 40% to 100% today. Japan's debt to GDP surge over the past 35 years resulted from massive government spending to revive a stalled economy, combined with collapsing GDP growth. Debt grew while GDP stagnated. During this period, huge stimulus packages funded infrastructure and social welfare programs, all attempting to end persistent deflation and low growth. Japan's rapidly aging population exacerbated the problem as retirees demanded more healthcare and pension spending. This significantly added to the debt burden. For years, this growing debt caused no real problems because the government borrowed at ultra-low rates. But now that rates are rising, Japan faces a stark choice: stop borrowing and start paying down debt, or see its massive borrowing become unmanageable. Japan's Prime Minister recently told Parliament he opposes funding tax cuts through bond issuance. This signals new caution about government spending as borrowing costs rise. The Japanese bond yield surge reflects global bond investors' concerns about unsustainable government spending. Higher Japanese yields are part of a worldwide trend where major economies face rising borrowing costs as investors doubt their ability to cover massive deficits. The UK's 30-year government bond yield spiked to 5.54% this week, up 40 basis points year-to-date. The UK expects a $185.5 billion deficit this year, slightly lower than last year's, but deficits are projected through the decade's end. China's debt-to-GDP has grown over 15 years and will likely continue as the country runs deficits to stimulate its slowing economy. While China long aimed to keep deficits below 3% of GDP, it's breached that limit 3 times since 2020. This year's target is 4% of GDP. The U.S. hit its debt-to-GDP record in late 1945 when national debt briefly exceeded the entire economy. After declining for 3 decades, debt fell to about 25% of GDP by the mid-1970s. Since then, it's grown steadily under both Democratic and Republican administrations. The global financial crisis pushed it to 75% of GDP, and the pandemic drove it near 100%. Historically, U.S. debt grows during wars or financial crises when unemployment is high and growth low. Today, the U.S. has the world's 8th highest public debt-to-GDP ratio. Right before COVID, the U.S. enjoyed its longest modern economic expansion. Yet unusually, debt remained high and growing. Normally at that expansion stage, deficits shrink. Instead, the U.S. deficit grew faster than ever, even before the pandemic hit. In April 2020, the federal government delayed tax payments, creating a cash crunch. The Treasury announced plans to borrow $3 trillion in just 1 quarter. Who bought all this debt? Primarily the Federal Reserve, which added nearly $2 trillion to its Treasury holdings in 2 months. That same month, Americans received their first stimulus checks. The Congressional Budget Office now predicts America's debt-to-GDP ratio will rise from today's 98% to a record 125% within a decade. What's remarkable is there's no war or recession to explain this rapid borrowing surge. In fact, U.S. unemployment remains near historic lows. The Committee for a Responsible Federal Budget estimates Trump's proposed policies could push U.S. national debt to 129% of GDP by 2034. On the campaign trail, Trump claimed he wouldn't run massive deficits but would balance the budget. While research groups estimate Trump's budget could add $2.5 trillion to federal debt over a decade, the White House claims it will save $1.6 trillion. Press Secretary Caroline Leavitt called it the largest savings for any legislation ever passed on Capitol Hill. However, this figure refers to spending cuts while ignoring that overall spending still exceeds revenues, requiring continued borrowing at market rates. Moody's predicts the U.S. deficit will grow from 6.4% last year to nearly 9% by 2035. During the 2008 crisis, massive Fed bond purchases didn't cause predicted inflation or crowd out private borrowers, making economists rethink debt limits. In 2019, former IMF chief economist Olivier Blanchard argued that when interest rates are below growth rates, governments can safely carry more debt than previously believed. Trump's gamble is that he can grow the economy faster than the debt. But his erratic trade policies, like suddenly threatening 50% tariffs on EU goods including iPhones, may undermine business confidence and investment. As analyst Robert Armstrong noted, shifting resources to manufacturing may actually reduce productivity if capital moves from higher value sectors. Despite claims of cutting wasteful spending, verified savings remain minimal. Most research shows governments only cut spending during crises, often worsening them. Politicians favor borrowing because repayment falls on future administrations. With 30-year rates above 5% and potentially anti-growth policies, managing debt becomes much harder. J.P. Morgan estimates Trump's trade wars could reduce global GDP by 1%. With elevated debt levels worldwide, slower growth would exacerbate debt problems. The IMF warns global debt to GDP is now 10 percentage points above pre-pandemic levels, with over half of global debt in countries where it's still growing. They recommend 3 to 4.5% of GDP in fiscal adjustments worldwide. Governments might try inflating away debt, but as recent years show, high inflation is politically dangerous. The coming years will test whether democracies can make tough choices before markets force even tougher ones upon them. If you found this analysis valuable, please like and subscribe our channel.